Hello, I'm Alex Davies, founder of Wealth Club, and today we're looking at whether now is a good time to invest in early stage companies through EIS funds. The Enterprise Investment Scheme, EIS for short, was introduced by Chancellor Kenneth Clarke in 1994. An ambitious scheme designed to encourage wealthy investors to back the nation's innovative startups. 30 years on, and having recently been extended for another 10 years, the scheme looks to be going from strength to strength. Each year sees around 4,000 early-stage British companies raise circa £2 billion through EIS. Successful companies that have received EIS investment in the past include Pasta Evangelists, the gourmet meal kit company, Bloom & Wild, the UK's top-rated flower delivery service, and Cognism, a provider of sales software to business. But is now a good time to be investing in an EIS fund? To find out, today we are joined by three well-regarded EIS fund managers with different approaches to EIS investment. Ed Guinness of Guinness Ventures, Fred Sonia of Hatch, and Andy Barrow of Protura. So welcome all of you. Before we go into it, I just want to ask each of you some quick fire questions about the EIS scheme. Fred, first of all, what type of companies can you invest in through EIS?
So you can invest in, EIS is designed for kind of small to medium-sized companies. So these are businesses that have less than 250 employees, that have less than 15 million in gross assets, and are typically at the point of the first EIS investment have been trading for less than 7 years. And in terms of sectors, generally, I would say kind of R&D intensive companies, so technology, scientific, manufacturing, but the list is a bit broader as well.
So Ed, there's some fantastic tax reliefs available with EIS. What are they? How do they work?
There's 5 main reliefs. First, income tax relief. Investors receive 30% income tax relief on their investments against their income tax bill. Second, capital gains tax relief. There is no capital gains tax on any capital gains that investors make in these investments. Third is, I'm going to say, a more complex relief, capital gains deferral. If you make a big capital gain and then invest it into an EIS qualifying company, you don't have to pay the capital gain on that until the eventual investment is realized. Fourth is one we don't like to promote too much, but loss relief. Investors are able to claim relief against income tax on any losses that are made in the portfolio rather than just against their capital gains. And last but not least, inheritance tax relief. So if investments are held for more than 2 years, then typically investors will see these assets falling outside of their estates for tax purposes.
Great. Andy, how much can you put into an EIS each tax year if you're an investor?
So, there's two EIS limits, if you will. The first limit being $1 million, and that's sort of your general EIS, and then you've got your spin out, which is your knowledge-intensive companies that are really heavy to R&D, and that's up to $2 million.
Perfect. So it's been a tricky 2.5 years really for venture investing. How's it been? I'll start with you, Fred.
Well, I think one of the big news stories of the last few weeks is that EIS has just been extended for another 10 years. So I think that's great news and something that's really positive that's come out of the last couple of years. I think the big shift that I've seen in the market, probably 2 things. One, more money coming earlier stage, actually, in my opinion. So I think funds that have backed companies at a really late stage, kind of expecting them to IPO as the next step, have kind of been caught a little bit short there, if I'm honest. And secondly, a huge focus on revenue, which I think is really important. I'm very passionate about investing in companies that actually have a business model, that have a path to break even, that want to be profitable. Doesn't mean they have to be, but it gives them choices. And I think that's been quite healthy for the economy and quite healthy for the model over the last couple of years.
And Ed, is it easy to raise money despite the downturn?
I think we've gone from a period in 2020, 2021 that was founder friendly. There was a lot of money chasing a lot of really great deals. Terms were pretty good. I think you've seen a definite slowing down of the rate of money coming into the sector, and the real benefit for investors who are looking at it are that the deals are now, I'm going to say, less hyped and more reasonably priced So there's a lot of opportunity out there today.
We've seen valuations come down, considering the peak. I think in 2021, I think twice the money went into venture in that year globally than the couple of years before. It was a real, a lot of money chasing not enough companies, and it was basically putting the prices up. So now it's a real, you're getting a better quality company with stronger market fit at a more reasonable price than where we were 2 or 3 years ago. So I think that's where the sort of market has changed. We've obviously had a little bit of AI has been a big thing. So that's sort of kept some of the valuations in certain areas a little bit higher, especially very knowledge intensive, and they need quite a lot of capital effectively to get them started.
And is this hype or is this
AI is
genuine?
not. Well, it's funny. I mean, we follow the same thing. We are going through a model shift. I think for times of investment to get on technology companies now, I think now is actually a wonderful time to be in, because I think we're reinventing software. I think we're driving software and we are interacting with it in a different way. I think you can see that from businesses that are coming out of America and the UK and other technology-heavy areas in the world. Now's a real good time that you can see the incumbents are being disrupted. So I think people can overuse that term disruption, but the reality is we're seeing search starting to change, business models things that you thought would be like that forever, and they never are. But you go, God, this is like a business model like Google that. It's probably one of the best business models in the world, and now you're seeing them slightly getting eaten by some of these AI startups, and there's so much exciting areas of software now where we're just exploiting different ways in which we can drive software, improve business process. So I don't believe it's hype at all. I think we all go through that and we all jump on the bandwagon, and you have the hype curve and the trough of disillusionment, and then everybody sort of works out where the value is, and you find the great companies, and that's where I think we are now.
I think the biggest challenge for us as investors is actually sorting through the hype.
Yeah.
So every deck that we receive has the word AI in it at the moment, and it's actually trying to understand, is this a true AI business?
Yeah.
Is this someone that's just using AI? And is it someone that's just included in their deck to try and get your attention? So actually, I think it almost makes an investor's job harder, because there's now this kind of market hype that you've got to filter through and work out actually where should you be investing.
And the funny thing is as well, I think people have tried to just try and almost wedge AI into their startup to make it more attractive potentially to an investor. I think that's where it gets more. We've seen domain names change from .com to .ai, so I think you're absolutely right. Looking at, exactly what is the business model, what are you effectively driving underneath, where's the intellectual property being, or are you actually wrapping someone else's technology, and there's just a very thin layer. So you have got to really have a good look underneath to see, are you really building capital value in the business through technology?
And Ed, do you see any very exciting sectors, or is it business as usual?
I think just to go back on the AI piece, there are a lot of businesses that are now using AI and potentially being more efficient with their growth with it.
Yeah.
And I think that's quite exciting, provided you're able to invest at the right price. The pure AI companies are in that hype sort of cycle. And you need to just look at it on its merits, but we find that area very difficult. We think there's quite a lot of opportunity right now in, I'm going to say, some of the more generalist sectors, healthcare, business services, even some of the consumer companies. So some of the consumer companies have been hit quite hard recently by softening consumer demand and not being able to hit the online growth that they were able to hit for the 3 years before. But actually that means it's a really fertile market for investing in companies that have real products, real revenues and real brands underneath it all.
And how have your companies, because you've got a lot of companies under management, you've been doing it a long time, how have they fared through the downturn in general?
We've been lucky that we've had some very good exits through the last 2 years. We've had £33 million worth of exits over the last 2 years. That has helped, I'm going to say, underpin our belief in the valuations in the portfolio. I think there's been a bit of a range in management response. Management teams who are good and on the ball have scaled down their ambition. They've looked at stretching their cash run rate so that they can survive for longer, and they've understood how to manage through this, because the really good companies are driving revenues through their expenditure and growth, and then the extra money's going on the new thing and the next thing, and they can manage that down. And I'd say most of the companies we're seeing have taken that message on board, but not all.
I think the best founders in our portfolio cut costs way before anybody else did. They identified the problem. I guess second time founders may have lived through this before, so they actually kind of saw it coming. But cash is king. It always has been. And I think the venture world over the last, a few years before the pandemic kind of forgot that. And founders just assumed that there would always be cash there. And the reality is that's not the case in the real world anymore.
Are you finding it hard, though, all of you, to actually find companies that want to raise money because they're putting it off? The good companies are putting off raising money until valuations rise again.
Probably depends where it is in the stage. Later stage, definitely, because they'll have raised maybe quite a lot of capital in a really bull market, and the gap's just so big, and they've probably got a bit more levers that they can play with. In the early stage, we see there's probably more deal flow now as people see more opportunity to create exciting companies. Some aren't raising as much. So where they maybe used to raise, multiple seven figures, and the dilution worked at a particular valuation, for example, of how much of that company you bought, trying to raise as little as you can and go as far as you can into the market fit cycle to try and make sure that you're providing value to those early customers before you actually realise and go and do a huge raise to sort of deploy capital into a business that maybe hasn't got its business model figured out. We saw a lot of that in 2021. A lot of people raised a lot of money and there just wasn't a lot of customers, and now everybody's much more disciplined.
Ed, what does this mean for investors? You mentioned that it's a good time to invest.
I think valuations are lower. I'm going to pick up the number of opportunities question as well. I mean, we saw 1,300 companies last year, and we invested in 15 of them. This year, we're seeing more than 100 a month. There is a huge amount of deal flow out there. And in terms of the quality of investments you're seeing, there are companies who you're seeing succeed, but they're having to be more realistic on their valuations. So, we see this both in follow-on investments and new investments. That you're able to have a sensible conversation with management and work sometimes with your other investing partners to keep the company pushing along, but getting more of the benefit coming to the investors.
So if you look at a company or founder, what's the key things you look at to think, that could be a successful investment?
First, I'd say people. We are obsessed by finding really good people. Ideally, have one or two people on the management team who've done it before, taken a company through to exit. But making sure you've got a good ability to have a good chair in there and a good finance director, giving the company purpose and direction. Second, a sustainable business model, an idea that actually adds up and and has legs, but recognizing that the management may need the flexibility to evolve it. And third, I'd say you look for a sensible investor base. You want to have people alongside you who want to see this company succeed and are prepared to go on that journey, because it's a long one.
I think team is so important because every business changes. I've never seen a business plan that's true. I've never seen a 3-year or 5-year
models are made up, right? Keep saying to people the models made.
Absolutely, that means anything.
What we think we're going to do.
So the one thing that should hopefully, touch wood, stay the same is the founding team. So I think it's really about people because these things change all the time.
Yeah, team's everything. The founding team now, I think you have to go a lot further with your founding team than maybe where you have before. So, for example, if you are building a software business, do you have strong development capability on the founding team, or are you relying on a third party to do that development for you, where you're just in a long cycle? The software needs to change because you're trying to find how you get the customer value. And then you've got to wait for someone to go and develop it, and you might be in a queue with an agency or something like that. So really what we sort of look for is a really strong co-founding team that has the ability to do something themselves without relying on a wider base, because I just think you have to go further, longer with much less resources. So I think that's one of the key things for me. But it always comes back to, we always used to, how many times do we hear the word grit? But you can sort of see that in the founding teams. What's their ability to cope with stress? What's their ability to navigate the gauntlet of starting a business? And what's their ability to make really, really difficult decisions with people, staff, cash, market, you name it. So loads of things. And then the market obviously helps on top. Right? I always believe good founders will find a base in a market. Try not to see around corners too much. With that founding team solid, you can usually build a pretty good business.
Good. And back to investors. What should investors be expecting? And I think I said to Ed first, because you've been doing this a long time, and you get all these preposterous claims, you're going to get 10 times your money, 20 times your money. What in reality, if someone invests in an EIS fund, what do you think they should be getting over sort of 5-10 years?
Sure. Well, our guidance that we give to investors over, they'll typically have 10 to 15 investors in their investments in their portfolio, is that over 5 to 7 years they'll make twice their money.
Yep.
But I see that as really just helpful guidance.
Yep.
We used to try and guide lower than that to say, you've got to remember this is a portfolio, and although we're going to have some big wins, there's going to be some failures here. But the numbers that we were hitting were, our achievements so far are 2.6 and 2.64 times on the exits we've had. So, saying anything under 2 feels a bit unreasonable.
And sort of over 5-7 years, you still think that's a reasonable time, or is that too small?
It's pretty good. Over 5 years, if you make 2 times your money, that's a 15% IRR.
Yep.
Over 7 years, 8 years, you're down to 10%, but that's pretty good. Given that you're not paying any tax on it and you've had income tax relief, I don't think you're going to find many other areas where you can hit those sort of numbers.
And Fred?
I agree a lot. I think guidance is guidance, and I almost wish as fund managers we didn't give any guidance because, like the model conversation a minute ago, we're kind of, making it up a little bit with some theory behind it. I think for me, I think that investing in venture is high risk, high reward. So I think you should always strive for the highest returns possible, obviously. And I think there is a path to generate returns that are north of 2, 3, 4, 5x if you have some home run companies and if they deliver some fantastic results. But you need a lot going right and a bit of luck mixed in there, and maybe not a pandemic in the middle of it to be able to achieve that. But I think venture is an asset class that should outperform everything else, and historically has, and that's why people get so excited about it.
But I don't know about you, but for our investee companies, actually the pandemic was really quite a positive period. There was capital available. Actually, online business models did better. You were looking at companies that didn't have leverage on their balance sheets. By definition, they had cash, so they could manage through it. And actually, that period, 2020 to 2023, was great. And it's actually been now with higher interest rates kicking in, and I'm going to say a bit more caution and concern amongst investors that it's a little bit tougher for these companies.
I don't disagree. I think the only thing that I saw in the pandemic that's probably negative was the delay in liquidity. So, those deals that you thought may be getting done, those M&A deals that you thought may be getting done, just having a delay there, in my opinion, was negative. But I think overall, lots of good came from a situation.
Yeah, tech was good. I think we had to be careful of the business models that survived in a pandemic that couldn't survive out of a pandemic. I think we saw those, quite a lot of them. So, you look at your Hoppings and businesses like that, where we just couldn't see that once the pandemic had settled, how it actually sustains that growth. So there was a little bit of artificial in there, but you're right, there was a lot of capital available. It was a great time for being a founder.
If there was something you could change about the EIS scheme, you may already have the ear of the government, what would you say to them?
Yeah, I think you've got to look at the limits again. It is an interest one to have a review of the limits, and are we still happy with those limits? Are they still realistic? Fred went through them all before, but are we, with inflation and with the market moving on and with the world moving on in general, are they still the right limits? I'd love, as a fund manager, that we're quite a big team, and I'd love to do something about the tax year end. I don't know how you guys find that, but hitting that deadline, obviously it's a tax efficient mechanism, so it comes down to tax year end. But that at that time is not necessarily good for founders, not necessarily good for fund managers, and it creates sometimes the wrong behaviour. So there would be something around that area that I think would be interesting to look at. How do you guys?
I agree. I think the tax year end drives this huge disconnect between investors and founders, where investors want, for the right reasons, under the current rules, EIS deployed, invested within normally quite a tight period at the end of tax year. But founders are not raising around because of that. They've not built a business around their requirement that they're going to run out of money in March or on the 4th of April or whatever it may be. I think it's quite a hard thing to legislate for, to change. It is. But I think it would be a great one. I guess the obvious one that anybody's ever going to say is to increase the tax relief, because that drives money into it. And I hate to be obvious, but 30% income tax relief, if it was higher, I imagine it would have an impact. I think one of the interesting rules around actually how much you can invest is actually the deferral of gain, that there is no limit. We have investors that invest more than the kind of headline million or £2 million limit through deferral of gain, and I don't think that's shouted about enough under that CGT rule. So maybe some more publicity around that is something I'd call for.
Very true. Ed?
I would throw in to my request list the 7-year rule. I think that there's a lot of interesting growth companies that have not raised EIS and been going for longer than 7 years, or end up purchasing a company that's been going for longer than 7 years and are then not able to avail themselves of the scheme. That means it just doesn't work. And I don't think the sort of the purpose of the scheme is served by that rule. The limits is, again, the thing I'd echo. We've had no inflation uplink on, whether it's the £1 million a year, whether it's the net assets test, or any of the other financial tests. And it would seem logical that there should be some sort of inflationary move on those.
So finally, a very brief summary from you all. Why should people invest in an EIS this year? And I'll start with you, Ed.
Well, I think with an ever-rising set of tax rates, investors are hugely incentivized to look at, I'm going to say, high-growth companies where they can get particularly the capital gains tax relief and capital gains tax deferral that will see them through, what is quite tricky economic environment, a tricky economic environment for individuals.
I think the most exciting thing about EIS for me is not the tax relief. We always talk about tax relief. That's what we focus on. But actually, we're investing in underlying companies, private assets. These are real people building really amazing businesses. So in terms of investors getting excited, myself as an investor, we as partners in Hatch have invested in every single tranche. That's because we're excited about the companies that we're investing in. We're excited about the innovation that they're building, and we're excited for the future.
Yeah, I'd echo both comments. I think EIS investing at the stage typically where you would be using an EIS scheme, it's incredibly fulfilling, can be incredibly rewarding, it's incredibly exciting, to be part of that company in some way, shape or form. Again, like you, I love finding amazing founders who are looking to crack a really interesting problem, and I'd love to go on that journey with them, and to be part of that as an investor is an incredibly rewarding and fulfilling thing. And then with the reliefs on top, like you say, they're the added bonus.
Fantastic. It's been great to speak to you, Ed, Fred and Andy. Thanks very much.
Thank you.
Thank you.
If you're watching on YouTube, please press like and subscribe to the channel for more.